Hello everyone and welcome to Economic Impact. Today is January 9, 2024 and I am with our Chief Economist, Stéfane Marion. Hello Stéfane, how are you?
Happy New Year, Denis.
Happy New Year to you. Stéfane, we had a spectacular year-end in terms of financial results once again, and it was good when we had our last Economic Impact discussion, but the last 2 weeks were spectacular.
Yeah, Denis, there's a lot of hope in the system, right? It's all the stock market increased quite substantially, but it was all due to price earnings expansion. So PE expansion means it's hope that the economy will turn around soon and deliver better earnings in 2024 versus what we had in 2023.
But at the same time, we saw that the global manufacturing is kind of a slowdown. It keeps going on.
Yeah, so hope doesn't mean what you're observing right now in the market. And what you're observing in the market, the most recent data shows that as of December, we've had 16 consecutive months of contraction, or let's call it stagnation, Denis, if you want. But it's not, even stagnation is not very conducive to a rebound in earnings in 2024. So that's the challenge for the markets, expecting potential rate cuts to happen to help. But at this point in time, it's not a great picture for the global economy.
You said it at the opening, but the expectation of, the earnings for 2024 are, I would say, spectacular when you compare to 2023.
Yeah, so you want me to put numbers on that, right?
Okay,
fine. So in 2023, there was no earnings growth, Denis. It was 0.1%. So the stock market did very well. As I said before, it was PE expansion on the expectations that 2024 would do better. And the expectations for this year is that earnings will rebound 10% globally. But notice, Denis, in that column, all regions are expected to deliver a rebound. So quite aggressive when you consider the state of the global economy that I showed on the previous slide.
Okay, is it because people are expecting that the inflation will go down faster and lower than what was anticipated in 2023?
For rate cuts, perhaps. So inflation's coming down because growth is slowing down. But in terms of pricing power, which is a key driver of profitability for corporations, the red line is what consumers are paying, Denis. The blue line is what producers are receiving. So the pricing power that was observed in 2022, where you can raise prices by 10%, it's no longer there. You can't raise prices more than 2% at this point in time. So from a producer standpoint, that is quite challenging to expand your profit margins under these considerations.
Okay, then if the market is expecting, more earnings, and their ability of pricing is lower, is it because salaries will go down?
One would hope so, and I think eventually that is the transmission of monetary policy, works with a lag. It will happen eventually, but right now, Denis, what you're seeing is that salaries, average hourly earnings, are still stuck at around 4%. So you're dealing with less pricing power, but wages that are still at 4%. So quite challenging for profit margins.
Yeah, not easy for those companies. But we have also the newcomers in terms of data that are coming, in the economic environment. It's once again cost of shipping. We have that in the COVID period, and now it's back.
Yeah, Denis, geopolitics is not going away in 2024, and we have to keep that in mind, right? Given what's happening in the Middle East right now, and the Strait of Hormuz is being challenged, as well as Panama Canal, shipping costs have increased, have more than doubled, almost tripled in recent weeks. So that will add to the dilemma faced by producers as they're now facing less pricing power, higher shipping costs, and perhaps a compression of profit margins.
Again, then that means that, once again, expectation of those earnings seems to be a bit high in the context.
It's aggressive. I'm just giving you the backdrop on which these expectations are based. Things have changed quite rapidly in recent months on that front, or recent weeks, just on the geopolitical front. So that's a big deal, in my opinion.
In the past, we discussed about the impact of interest rates on the manufacturing sector, and now we see the impact bankruptcy going up again.
Well, that's how it works, Denis, right? We've said it before. You raise interest rates quite aggressively, you're going to get some impact on the economy at some point in time. And what we've seen in recent quarters, there's a pickup in the number of bankruptcies. So corporations, again, are faced by all these factors I've mentioned previously, plus they need to cope with the impact of previous interest rates as they need to refinance their corporate bonds at a much higher level. So that is an impact also on corporations.
Yeah, and as usual, we saw the employment number last Friday. It was not a good number when you look at it, in deeper.
Well, they're a bit confusing. So given all the factors we mentioned, if you're going to try to protect profit margins, then what you have left at this point in time is maybe you want to streamline your head counts. And whereas jobs were up in December in the U.S., head counts overall in the U.S. economy were up, jobs were up roughly 200,000. There was a big contraction in full-time jobs. So again, this is the adjustment that corporations are doing to protect their profit margins. And Denis, outside the COVID recession, that was the biggest decline in full-time employment in over a generation in the U.S. So clearly, there's something happening with past, impact of previous rate hikes is leading to a reaction function from U.S. corporation to streamline their headcounts. That could have an impact on consumption and therefore earnings growth in 2024.
Once again, but about Canada, and in Canada, we had the number also, and I think Ontario was really impacted by the payroll.
Yeah, corporate profits have been down for a few quarters in Canada, so you would expect at some point in time also to impact the employment data. So what we saw in Canada is similar to the U.S. Total jobs, relatively flat on the month, but a big adjustment downwards to full-time jobs. And in terms of, from a regional perspective, Ontario, we know the impact of interest rates will bite, more in provinces where home prices are higher and higher indebtedness at the consumer level. So the employment to population ratio, the adjustment we're seeing right now in Ontario is quite large, Denis, because we've fallen to below 61%. Outside the COVID recession, you have to go back to 2008. So clearly the impact of previous rate hikes is also biting on the Canadian labor market.
And lastly, one of our favorite subject, demography, I would say. And once again, you have numbers that prove that there's a lot of new immigrants in Canada.
Yeah, so just after we did our last show, a couple days later, there were Statistics Canada published new population growth number, which exacerbates the downtrend in the employment to population ratio that I'm showing to Ontario. It was just spectacular. It was the biggest increase, more than 400,000 population growth in an entire quarter. That even exceeds the quarter when Newfoundland joined Canada in 1949. So I think it was close to 430,000 people. Denis, at this point in time, I know the policymakers are saying we need to grow our population to, compensate for an aging in the population. But right now, Denis, Canada's growing 6 times faster than the OECD average. I don't think we're aging that fast, and all provinces are showing at least twice the growth of the OECD. So what that says, Denis, to me is that housing will be an issue again in 2024. Home prices will not be collapsing just because of this population surge, but rent inflation will be higher, and the end point, Denis, means that a component of inflation will be higher, limiting the ability for the central bank to cut rates. They will be cutting rates, Denis, but housing, due to strong population growth, will limit the downside on interest rates.
But you showed us, last year, I think it's December, that without the component of a household, the inflation is already around 2 or even below 2%.
Right. Without housing, we're at 2%, but because of housing,
those numbers, we're going to be still above 2% no matter what.
We're close to 3% at this point in time. So rate cuts are coming in Canada. That's good news for households, for homeowners, etc. But they won't be as aggressive as in the past due to this surging population.
But with all of that, rate cuts more at the end of the year, or middle of the year, or where do you see that?
I think starting in the second quarter of this year, we'll see the beginning of rate cuts, I think, globally. So I think that's good news for the global economy. But central banks will be cutting rates because the global economy won't be doing so great. So I know everyone is positioned for great news, rebound in earnings. I still think that the economy might disappoint in 2024, hence our view that, I know we've been saying that for a few months, but we're still in that window where there could be more volatility on the economy than people expect for the next few quarters.
Well, thank you, Stéfane, for all those forecasts for 2024. Once again, thank you. Thank you, everyone, for being with us. We'll see you next month with more data and more news.